Is there really a new and unfair mortgage tax coming for those who have good credit scores? Recently, I've been bombarded with lots of Twitter articles, Instagram stories, YouTube videos, and news articles sharing this same kind of headline. Now, before you stop paying your credit cards thinking that you're somehow going to get a better deal on your mortgage, let's actually talk about what's really going on here. But before we get any further, let me just start by saying you will absolutely not get a better deal on your mortgage if you have bad credit. So then what's the deal with all these headlines saying the opposite? In this video, you're going to learn about all the new changes that are coming to conventional loans. I'll explain exactly what these new loan level pricing adjustments are and what changes are actually happening. We'll go over some specific examples, and by the end of this video, I'm going to actually share with you my #1 strategy for avoiding these new changes altogether. Now, if you're new here, my name's Keaton. I'm one of the top loan officers in California. And on this channel, I help people just like you learn how to buy their first home and make the mortgage process a lot easier this year. Now, if you're thinking about buying a home this year and you want to see how these changes actually impact you individually, I've left a link in the description below to schedule a one-on-one call with me and my team. We'll look over your finances and we'll figure out how these changes actually impact your plans to buy a home this year or whenever you're ready. And now, while it might sound like these changes coming to mortgages might make it a little bit harder for you to buy a home, let's jump into actually what's going on, and I'll show you how you can actually make your home buying process a lot cheaper. Now, to start, this all has to do with some of the changes that are coming from Fannie Mae and Freddie Mac regarding their loan level pricing adjustments, or LLPAs for short. These LLPAs are adjustments based on different characteristics of your particular loan. These include things such as your credit score, your percent down, how big your loan amount is, where you live, the kind of property type, your FICO score, and pretty much everything in between. Now, Fannie Mae and Freddie Mac have been making changes to their LLPAs for years. This isn't really anything new. And they do this because they're constantly reevaluating what they consider to be risk factors. Now, it should sound obvious that less riskier loans tend to be cheaper loans for consumers. So these changes are all part of their long-term goals to continuously be evaluating risk to make sure that the housing market never experiences what we saw in 2008, as well as making mortgages more affordable for everyone. And now in January of this year, they announced some new changes to their pricing guidelines. In their own words, Fannie Mae says that they are implementing additional changes to their LLPA framework that represent the next step in their efforts to increase support for borrowers who were historically underserved by the housing market while ensuring a level playing field for small and large lenders. And as I mentioned, this is all part of their long-term goals to continuously reevaluate risk and adjust their pricing accordingly. Now, specifically, these coming changes are targeted at very specific buckets for loan to value and FICO score. Now, although these changes are set to go into effect on May 1st, most lenders have already put this into their pricing since March. And the reason why is it can take a couple of months for the lender to actually deliver these loans to Fannie Mae. And since these changes are for any loans delivered to Fannie Mae on or after May 1st, you can imagine that most lenders have had this in their rate sheet for a long time now. And that's really important because what this means, if you're watching this video and you've been looking for a home for a little while, you're actually not going to see any changes to what kind of interest rate or what kind of fees that you're paying for that rate come May 1st. If anything, the biggest changes that you might be seeing is a lower interest rate because inflation is still the biggest driver, and we're starting to see inflation on a little bit of a downswing. So if you're worried that come May 1st, you're suddenly going to be paying more for a mortgage, that's absolutely not going to be the case. All right, so now that you understand what these loan level pricing adjustments are, let's actually dive into what's changed. First, let's take a look at that graphic that pretty much every news article in America has shared so far about these changes. For starters, this isn't the actual fees that anyone's getting charged right now. What this graph represents is what kind of changes are actually coming from the old to the new. Additionally, it's been color coded, so anything that has had an improvement in price is marked in green, and everything that's gotten worse is in red, and all the colors in between. So you'll notice here that for lower down payments, pretty much anything less than 5% down, across the board, regardless of FICO score, there's been a little bit of a pricing improvement. Additionally, for FICO scores that are 660 and under, there's been an improvement there as well across the board. Now that big red target in the middle there, that's what everyone is obsessed about. So really the biggest changes are coming for those who have credit scores between 720 and 760 and are putting more than 15% down but less than 20%. Now, why that area specifically? I got this great before and after graphic from Mishtalk, and it actually shows what the loan level pricing adjustments were before the May 1st change and what they'll be after. And this shows why those specific ranges were targeted. You see, there used to be this sweet spot in the LLPAs where you could put more than 15% down, but less than 20%, and you would effectively get the same rate as somebody who was putting down 25% or more. So as a mortgage lender, what I used to recommend is if you had 20% to put down, I would usually recommend you actually put a little bit less. Well, yes, you might have a little bit of mortgage insurance for a few months. You would also have a much lower interest rate. And then from there, you could either recast the mortgage after 6 payments or just wait until the mortgage insurance automatically fell off, which would be pretty quick. What you also saw is if you were putting less than 20% down, there was no real adjustment between putting 20%, 15, 10, and so on. But with these new changes, you can actually see a graduated step based on not just your FICO score, but also loan to value. So these new changes have basically closed that little loophole that you used to have where you could put less than 20% down, get some mortgage insurance, and get a way better rate. So those buckets in particular are where the biggest changes are coming from most borrowers. It's also worth noting here, they've added some FICO score buckets as well. Under the old FICO score matrix, everyone with a 740 FICO score or higher basically got the same rate. In between buckets, there used to be bigger jumps. So before, under the old fee structure, the difference between having a 700 FICO score and a 720 FICO score was a 0.5% in fee. But now the difference between having a 700 and a 720 is only 0.25%. So they've essentially added some additional buckets of risk in between, depending on your FICO score. So now people with a 780 FICO score are getting a much more obvious benefit than somebody with, say, a 740 or even a 700. So essentially, they've added these extra FICO score buckets in order to give a little bit of a bigger reward to those with a higher credit score, while still not punishing you for having just a slight difference. I mean, imagine that. Under the old fee structure, somebody with a 719 FICO score versus somebody with a 720 FICO score was paying a 0.5% difference in fees. So on a $500,000 loan, that's an extra $2,500. So while yes, some particular FICO scores are definitely hit a little bit harder than most, but that's how Fannie and Freddie basically were going to be able to level the playing field and give people with higher credit scores a bigger reward without punishing people for having just slightly lower than perfect credit. Now, as I mentioned, the big thing to note is that that particular graph wasn't a really great representation of what people are actually paying. That's just a representation of the changes that are coming. So let's actually dig into some of those changes and how they actually translate not just as a percentage, but as dollar amounts for some of the most common price ranges and for FICO ranges. So for all these examples, I'm going to be using FICO scores of 780, 740, 700, and 640 just to be able to show some examples here. So first, let's start with the changes. As I mentioned, some of those biggest changes are coming for those people in that 720 to 760 range. So in this example, 740's got the biggest hits. And it's really in that 10 to 15% down range. Elsewhere, throughout the FICO scores and throughout the down payments, the changes are minimal or there's been some improvement. Now, percentages are obviously very subjective and it's hard to kind of get your mind around. So for all these examples, let's use a $500,000 loan. Another important thing to note is that typically lenders won't pass this fee directly to you in the form of a fee. Usually they'll just build that into the rate sheet. So instead of paying for the same rate and getting a higher fee, you'll just pay a higher interest rate. So let's look at the LLPA fees after the changes and you'll see that it's pretty well stratified. So going straight down the list, for a 780 FICO, putting 3% down, you're paying a 1/8%. 5%, you're paying 1/4. Same for 10%. For 15% down, you're paying 3/8, as well as for 20% down. Now you can pause if you want to take a look at the rest. But the point is here now with these new LLPA changes, there's a very obvious and graduated step between what down payment you're putting as well as your FICO scores. So yes, obviously some people are paying a little bit more than they were in the previous fee structure. But with this one now, there's a more obvious reward for having a slightly higher credit score as well as a slightly higher down payment, with the exception of some particular buckets where you're putting 20% down. It seems that at those particular FICO ranges, they would rather have you put less than 20% down and have mortgage insurance instead of putting the full 20. Now, as to why they think that, they've already got their analysis, they've done their research. I don't know that particularly. So now taking a look at those fees as they translate to dollars, somebody with a 780 FICO putting 15% down would effectively pay an $1,800 fee, where somebody with a 640 FICO would have a whopping $12,500 fee for the same rate. So this obviously dispels the idea that anyone with a lower FICO score is somehow going to get a better deal than somebody with a higher FICO score. What I really think this does is reward people who have FICO scores that are 720, 740, and so on. Because typically under the previous fee structure, there wasn't as big of a reward between having certain FICO scores once you were over 700. Now this creates a very obvious stepped tiered grid depending on how much your FICO score is and depending on your down payment. So while yes, obviously this does increase the fees before and after for what people were paying for particular FICO scores, like I mentioned, especially in that good credit range of 720 to 760, it ultimately closes those loopholes that we were talking about and now creates a very simple and easy to understand fee structure where depending on your FICO score, the higher it is, the better rate you're going to get. Additionally, this also doesn't penalize people as hard for putting less money down, because ultimately when you're putting less money down, you're going to have PMI some way, somehow. So these new changes help offset some of those costs that you would have to pay if you were putting less than 20% down. So now this new fee structure actually rewards people for having higher credit scores and actually gives you a clearer incentive to get that score into the next bucket. And additionally, it doesn't penalize you as hard for not having 20% down and going with a conventional loan instead of going with like an FHA loan. loan. And you'll notice some of the biggest improvements were in that range where most people would go with an FHA loan, putting less than 5% down. And the timing couldn't be better because FHA rolled out their changes lowering mortgage insurance premiums, which typically people are putting only about 3.5% to 5% down on an FHA loan. So Fannie Mae and Freddie Mac are actually saying, hey, we understand that we've got higher rates than our FHA counterparts, but if you bring that business here and you're doing less than 5% down, like you would with an FHA loan, you can still get a comparable rate. So ultimately, the way that Fannie Mae and Freddie Mac went about these changes are definitely not perfect, but once you see the final graph of how these FICO score tiers are put together and what the loan to value buckets look like and how they all work together, it kind of does make a little bit of sense now as opposed to the old structure. All right, so now that you understand the changes that are coming to the LLPAs, what if you still want to find a way around them? So if you're that borrower right now who's probably worked their tail off to make sure they've got great credit and a big down payment, they finally got to that 20%, and now they're looking at this fee structure and realizing, hey, I'm not getting as big of a benefit doing it this way. What would be the move then? Well, here's what I would recommend you do. Since they effectively closed the old loophole where you could put more than 15% but less than 20%, the new area that I would look at is putting 10% down. See, under the new fee structure, you're going to be paying less of an LLPA putting 10% down as opposed to putting 20%. And if you've got good credit, you could probably get away with having no mortgage insurance here as well. So what I would do is I would put 10% down, and depending on where your FICO score is and where your DTI is, you may or may not have PMI. But then after you've made your sixth payment, you would call your mortgage company and do a recast and put the rest of that 10% down, effectively lowering your mortgage payment and getting rid of PMI if you had it. Doing it this way is going to take a little bit of extra effort, but you're going to end up with a better result. So you'll still get the best of both worlds. You'll get a great rate because you put less down, and your mortgage payment, of course, will be lower as a result. Taking it a step further, there's another trick that every first-time homebuyer can use as long as you meet the income requirements. You see, on top of these LLPA changes, they slipped in another thing under the rug. Now, if you're a first-time homebuyer with a qualifying income up to or less than 100% of your area's median income, or if you're in a high cost of living area up to 120%, you can have your LLPAs completely waived. And that is regardless of credit score. So you'll have to check with Fannie or Freddie Mac's income limit tools depending on the area of where you're buying that home. But as long as you meet the requirement of being a first-time homebuyer and being under those AMI requirements, you're not going to be paying any of these fees at all, which ultimately means you're going to get a way lower interest rate. And so that benefit is not something that is unique to just low credit borrowers. That is for everybody. And what's great is that Fannie Mae and Freddie Mac recently increased the AMI limits across the nation. So you might want to check and see if you didn't qualify for that before, you might be able to qualify for it now. All in all, regardless of people's opinion on these coming changes, they are happening or have already happened. Ultimately, it's not up to me to decide whether or not these are fair, but rather, I'd rather show you exactly how you can take this news and apply it to buying your first home. So now that you actually understand what's happened here, let me know in the comments below what you think. And if you have any more questions on how this impacts you directly, as a reminder, I've left a link to book a one-on-one call with me and my team to help you get pre-approved for a great mortgage this year. Now, speaking of which, one of the most important parts of the entire home buying process is getting pre-approved for a great mortgage. It's the number one thing you should be doing before you even think about LLPAs or looking at homes or anything else. So lucky for you, I've made a video covering all my best tips and tricks. You can find it over here. But once again, thank you so much for supporting the channel. If you like content just like this and want to support me, just hit that like button and hit share and share it with somebody. It really helps support this channel and helps it grow. And if you want to stay up to date with all the latest mortgage content and news, make sure you hit that subscribe button as well. But that's all I've got for this particular video. I'll see you in this video next. See ya.